For understanding surplus on revaluation of property, plant, and equipment, we must know that the fourth schedule of the Companies Act 2017 requires Pakistani companies to disclose the surplus on revaluation of property, plant, and equipment as a separate line item under equity in the statement of financial position. For example, this is an extract from the statement of financial position of Attak Refinery Limited, and here under equity and liabilities we see this item surplus on revaluation of freehold land. For understanding of surplus on revaluation of property, plant, and equipment, we must first understand how the items of property, plant, and equipment are actually measured. An item of property, plant, and equipment is initially recognized at cost, and after initial recognition, an entity may use either a cost model or a revaluation model for measurement of such items. Under cost model, an item is recognized at cost less accumulated depreciation and any accumulated impairment loss. On the other hand, in revaluation model, an item of property, plant, and equipment is reported or carried at a revalued amount. And this revalued amount is in fact the fair value of that item at the date of revaluation less any subsequent accumulated depreciation or any subsequent accumulated loss, impairment losses. Now, this revaluation of an item of property, plant, and equipment may result in a situation when the carrying amount of this asset is increased as a result of revaluation, and this happens when at the revaluation date the fair value of the item is more than the carrying amount. Now, in such situation, the increase in the value or the increase in the carrying amount of the asset is credited to other comprehensive income, and this increase is reported in equity under the separate line item surplus on revaluation of property, plant, and equipment. For example, suppose an entity has acquired a piece of freehold land at cost of rupees 100 million, and this entity revalues its freehold land on yearly basis. So at the end of first year, suppose at the date of revaluation, its fair value happens to be rupees 120 million. Now this surplus of 20 million will be credited to other comprehensive income, and it will be reported under equity as revaluation surplus or surplus on revaluation of property, plant, and equipment. The same way, sometimes the carrying amount of an item of property, plant, and equipment is decreased as a result of revaluation, and it happens when the fair value of this item of property, plant, and equipment at the date of revaluation is less than its carrying amount. In such scenario, The decrease is directly expensed in the statement of profit or loss. For example, the freehold land which was originally acquired at a cost of rupees 100 million, if at the date of next revaluation its fair value comes out to be, for example, rupees 80 million, then this deficit of 20 million will be directly expensed to profit or loss account. Sometimes an item of property, plant and equipment which was previously revalued at a deficit at a later revaluation date is revalued upwards. In this case, the increase is recognized to profit or loss account to the extent that it reverses the previously recognized revaluation decrease. Similarly, sometimes an item of property, plant and equipment which was previously recorded at a revaluation surplus at a later revaluation date is adjusted downwards. In this case, the decrease is recognized in other comprehensive income to the extent of any credit balance existing in the revaluation surplus in respect of that specific item of property, plant and equipment. The decrease recognized in other comprehensive income in fact reduces the amount accumulated in equity under the heading surplus on revaluation of property, plant and equipment.